Hi everyone, uh, welcome to the Rebel Income live stream. As always, looking forward to getting started today. Really quickly, let me just get my sharing going. There we are. Outstanding. Okay. Normally, I like to take just a couple minutes here at the beginning and just kind of talk about some of the different ways that you can interact with me and with the Income community. I'm going to shift gears here just a little bit to start, and please hang on here and stick with me for a moment because there's something that I want to talk about, especially if you're on Discord. I've gotten some reports that I've gotten some reports from people who are on the Rebel Income community that they're getting contacted by somebody who looks like me but is not. In other words, they have they have the same. Uh, this individual uses my avatar, and they're calling themselves Thomas. However, their name is not Thomas. That's me. Um, the username that this individual is contacting people with is TH0MAS. I want to make it very clear. He has stolen my. He's using my my avatar. He's found it, and he is using a variation of my screen name, but this is not me. Part of the problem is that his communications, he will reach out, he will send you friend requests. If you accept those friend requests, he will engage with you. He will sound very much like me. It's apparent he's attended some he's viewed some live streams and some of my content, and so he has an idea of how I communicate, and it will seem very much like me. The reports that I've gotten are that he's looking for people to send him money so that he can trade it for them. I have not gotten any indication as to whether those people have been able to get that money back. But this is one of the things that you should be aware of is that scams on Discord do happen. And you should always be very careful before you respond to any friend requests or to any kinds of solicitations for funds. Um, Again, this individual is not me. This is somebody else that is using my name and my avatar. I am presently looking into what kind of options and alternatives I have to report this individual. However, what I will say is that uh, if you suspect somebody of being a scammer who has reached out to you, let me just give you an example, just for the sake of. I'm not saying any of these people are other than who they say they are, but let's just say, for example, that I was concerned here that Traders Pro was a scammer. When you right click when you click on these three dots over to the far right of any direct message you get from somebody that you suspect may be a scammer, you can report the message to Discord, and they will investigate. Exactly what kind of measures they may take, again, I'm not sure, but that is the most direct way that we have to try to control and deal with these people is through that function. I have not been contacted by this individual, so I don't have that ability. So I'm trying to look into what other alternatives I have as my own server admin. But please be cautious and exercise your own discretion. And remember, I will not send you a friend request. If you send me one, I will accept it and I will respond to messages. But certainly if I do send any messages, it's going to be to the entire community. I'm going to use the open discussion forum. I will not send you a direct message to you alone, and I will certainly not. You've already paid for the access that you've got, and I have no interest in trying to trade anybody's money. And so this is something I will not ask you for any additional funds. It's just not going to happen. So if you see somebody that is using my picture, sounds like me, but is any other variation than me, and is asking you for money, report them as a scammer, please. To be clear, my screen name is one of two things. You're either going to see Rebel Income or Thomas _ 90,017. That's 90017. That is me. Any other Thomas is not. Okay. Thank you for your patience. I appreciate you bearing with me on that. Now let's go ahead and get to the whole point of the session today, and what obviously I certainly enjoy, and hopefully you do too, and that's being able to talk about what's going on in the market, reviewing some of the currently open positions that I have, and that you may be as well. It is the third Friday of May. Amazing how fast the week goes, right? That means it's Expiration Friday. It is Expiration Friday for standard expiration options. So that means there's a lot more options that are expiring today. And certainly in terms of the trades that I have been following, I have a number that are on deck today. So we've got plenty to talk about. We'll probably have some time to go over some other things that you're interested in. If you have comments, questions, perspectives, something that you would like to have me review for the group, and you don't mind sharing some of the things that you're following as well, certainly put them into the chat. If you have any comments, questions, then do that as well. I'm going to be paying attention to that and trying to fold those into the discussion. All right. The first position I want to review is a put sale on Conagra, CAG, that I placed in the middle of April. This was a month ago. Conagra is one of those stocks that I like to follow, but does not offer really weekly options. And so typically, if I place a trade in the stock like this, it usually means going out a full month. I sold the $25 strike price, brought in 75 cents on this. This was right in the midst of a lot of the tensions and fears around tariffs, and that pushed volatility on stocks very high, and therefore implied volatility on their options higher. And that's why I was able to get a 3% premium on this for the 30 days. That was a little bit abnormal, but okay. Sold 2 contracts, and again, working with the $25 strike price. So let's check in on the stock and see how we're doing. As the whoops, I can type. There we go. As the market has shifted momentum in the last few weeks, well, really just in the last week and a half, 2 weeks, since Trump administration announced kind of on a surprise basis that the U.S. and China had mutually agreed to a 90-day agreement to reduce reciprocal tariffs. That's given the market some really positive momentum and allowed it to really rally a lot higher. The gap that we have here in the S&P, whoops, let me switch to my drawing tool. There it is. This gap, that's from that. That's reflective of that announcement. This is Monday. The announcement came out Sunday, and has given the market a big lift, obviously. So we're seeing a lot of bullish momentum moving into the market right now, and a lot of stocks are rallying as a result. as people are really excited and hoping that uh, trade wars are going to be avoided, and therefore some of the major influences that people are afraid was going to put the economy into a recession, and therefore the market into a more extended bear market are probably not going to happen. Well, we'll see. I'm not totally convinced just because Trump is Trump. And we know that things can change very, very quickly. But in terms of what that's done for the kinds of stocks that I like to pay attention to with Rebel Income, especially food products, which I've been using a lot to try to present a defensive alternative to market uncertainty. It's pushed a lot of these stocks lower. Not necessarily saying that there's anything wrong with these companies or these stocks, but they are out of favor. The market's attitude right now, with this significantly bullish momentum that we have now, this is what I hear a lot of analysts talk about, and they refer to risk on trading. Risk on means that the market is, in a very, very broad sense, embracing an aggressively bullish stance and sentiment. And so they're looking actively at growth names and pushing those kinds of stocks higher. That also tends to mean that stocks that are a little bit more conservative in nature, defensive names like Conagra, for example, will generally be out of favor. And so where we're seeing these declines, what I'm reading at this as is a reflection of people who were buying these stocks to be a little bit more defensive are now selling and shifting their assets to go chase growth. So this is a technical. This is a clear sign that the bearish momentum is increasing on these. Conagra is down at 22.76, and so barring a rally up to above 25 in the next couple of hours, extremely unlikely. I'm going to be assigned, and that's fine. I sold 2 contracts, so I have a $5,000 reserve on this, and I'm going to be in, and I'll be down here a little bit over $400 on the position once I'm assigned, assuming the stock doesn't change too much from the price that it's at right now. What do you think? Is that a bad move? Go ahead and I'm interested in your perspectives, given the way that the market has shifted momentum very, very quickly just in the last 5 days. Is it a mistake to try to keep working with more defensive names and trying to stick with a stock like Conagra, where bearish momentum is clearly accelerating, certainly in the last 3 weeks, and certainly in just the last 5 days? Put your comment in the chats. Tell me know what you think. If you're working with this as well, have you taken a different approach with Conagra in terms of trying to manage the position? We talk sometimes about trying to manage your trades more actively, and that can mean that if a stock is significantly below the strike price that you've sold and you don't want to be assigned, you can buy it back. I take it back. Earlier I said Conagra doesn't offer weekly options. Clearly they do. Let me expand my strike prices. There we go. So remember, I brought in 75 cents on this. If I wanted to avoid the put sale assignment today on this, I would have to pay $2.60, which would mean absorbing a loss of $1.85 per share. per contract. So that would be a little over $350 net loss that I would be absorbing if I wanted to avoid the assignment on this. If you think that there's even more downside in Conagra, that may be something to think about. Barry, already in it, signed a couple of weeks ago on 5/1. Yeah. I have not been, but I am going to be today. So I will be on the same boat. Thank you, Barry. Again, part of this just really depends on what your perspective is about the stock and what your attitude is about being willing to own it. This is a stock that has a very, very attractive value proposition. It did at 25. That means it's even a little bit better down at the current price. Those fundamentals have not changed, by the way. Just because bearish, the momentum in the stock is bearish. We'll see if this the stock was able to form a pivot low here on Wednesday, down around 22.50. Give maybe a good time for a short call vertical. Maybe one of the things, kind of to your point, Gib, I'm really personally not in favor of selling a naked call, even when bearish momentum is very, very strong, just because if momentum reverses for the stock very quickly, the S&P 500 is a great example of this. What if in the middle of April you sold a call option against the S&P 500 when it was down in this area, seeing all of this big chop? And you expected that this bearish momentum is going to continue because, boy, the trade war is starting to heat up and this looks really, really bad. Well, look what happened after that. This sharp rally back opposite would put anybody who sold a naked call in a very, very bad position very quickly. Far worse. Short calls, naked calls are even more aggressive than naked puts are. Because the theoretical upside from the call is unlimited. So your potential loss is unlimited. Whereas with the put sale, it's not that there couldn't be more downside in Conagra below its current price, but if the stock can hold support down here, find a level to stabilize, at some point, the market will start to recognize the value in the position in their fundamental strength. So where I might consider a variation on what I think Gib is referring to here would be, once I own the stock, I might consider selling a covered call against those shares. So, for example, if I went out a couple of weeks, maybe 3 weeks, for example, here at 23, which is just a little bit out of the money, here's a $40 call or 40-cent call on the bid at the $23 strike price. That's not bad from a yield standpoint. However, if the stock suddenly were to push above 23, I'd have to manage that trade very quickly. Be very nimble and expect to try to buy that back at a loss. It's one of the reasons I typically don't sell covered calls when the stock is below the strike price that I was assigned at. Is I personally am not interested in trying to manage the trade that actively. But there have been a lot of members of our community who have done this on stocks they were assigned that are significantly below the strike price that they sold. And if the bearish momentum continues, for that matter, if the stock just stabilizes around here and it stays pretty much flat or goes lower, then that covered call is going to expire worthless. You're still going to have your shares. And that can open up some opportunities to kind of do that again and again and again. use the covered call premiums against your net cost basis in the stock. I've seen a number of people use that strategy to pretty good effect as stocks have extended their downward trends. I'm not so sure about that for Conagra, I'll be honest, just because of how extended the downward trend now is, not just in time. It started in September of last year, and now here we are. This is definitely a long-term trend, but it's more about the size of the drop to me, going from about 33 now down here to about 22.50 at the low point. This is extremely oversold. So we'll see. 25 is also not so far away from the stock's current price, despite how the chart looks. It's not going to get back to that in 2 days or maybe even a week, but I'm willing to be patient on this. The dividend here is more than useful enough, 6.15%. So I'm willing to hold on to that and let that play out. So we'll see. We'll see. But in any event, I am going to be taking that assignment. Okay. And again, if you're going to be taking a different approach, if you have a different perspective or question on this position, then feel free to throw it out there. So, okay, let's take a look at the next one. Talk about Levi Strauss, the denim company. Seemed a little bit odd to be placing this trade. I'll be honest with you. It felt a little bit surreal. I'm not going to say odd necessarily, but a little bit surreal placing this trade in the middle of all of the trade fears. But again, trying to take advantage of some of the higher implied volatility, and with Levi Strauss's overall fundamental profile and a really steep discount at 14, which is the strike price that I sold, it just became really hard to pass it up. That's worked out pretty well, but I brought in 40 cents on this one and sold 3 contracts. So let's take a look. Stock's at 1758, so no stress. This has worked out pretty nicely, especially as news about trade has eased some of the fears, not just China, but also the 90-day pause that was put on Mexico and Canada as they came to the table. So that's given the stock a lift here in pretty nice fashion. It is pulling back the last couple of days, but that's not too worrisome. Certainly, the stock's not going to drop about $2.50. Excuse me, $3.50 in the last few hours of the trading day. So this looks like I'm in a pretty positive position. Again, just talking about opportunities to maybe think about leveraging that momentum a little bit. Considering that I sold this option for 40 cents, this is saying that the asking price is 15 cents. That's maybe what it's listed at, but reality is, since this option is expiring today, could probably put in, if I wanted to try to close this out before the market closed, I could put in a sell to close at 5 cents, 2 cents, something like that. At some point, the market would probably take it. Even if that doesn't immediately open up the opportunity to sell another option, because I have to wait for the market to come to me a little bit, is there another advantage to buying this back versus letting it just expire? Normally, if you buy an option back, you're able to redeploy the capital almost immediately. And I'm not saying that's not what would happen here, logistically speaking. But again, thinking about the literal mechanics of how this would work, considering where the asking price is, if I were to put in a buy to close at a 2 cent level or something, even if I were to take it, even if I were to do that, I would probably have to wait possibly until close to the market close before that trade would occur. That means that even if the capital comes back to me immediately, I'm not going to be able to, I may not have time to deploy it before the market closes for the day. But Barry, thank you for your comment. It says you could use your money sooner to redo or look elsewhere. If nothing else, it puts it closes the position and settles it faster than what is going to normally happen. I'm going to let this expire, and normal trade settlement will be 1 to 2 days. So my capital will be ready by Tuesday for my next trade. That's great. That's okay by me. But if I were to buy this back and it were to fill before the market closed today, then I'd be able to look for my next trade on Monday, not necessarily Tuesday. Sounds like a very fine difference, but sometimes that 1 day can make a big difference, not only in terms of price movement, but again, when we're talking about things like trading frequency on a repeated basis, even a day can make a difference. So you're right. You can use your money sooner to redo it. I could work with Levi at a higher price if I wanted to. Or, as Barry was saying, maybe look elsewhere. I like Levi. I like it at 17. I'll be honest. So this is one that does not offer weekly options. So the next trade up would be a little over 1 month out right now. But there's 35 cents, just a little over 2%, which isn't terrible. That's interesting. Is that going to make Levi my next trade for next week? I don't know. Maybe. I like the stock enough that may be worthwhile. And this momentum is generally a positive thing. Selling 17 here with the stock at around 1761. And kind of it's starting to stabilize around the 200-day moving average. If it can pivot and bounce higher, then we could see it come up here to about, what's that, 1950 to next resistance. So that could still be interesting. If you've done better, if you worked with the same trade and you beat me numbers wise, I'd like to see that too. So please feel free to let me know. Put that in the chat as well. I like to hand out tally marks. So okay. That's Levi. Next one on deck is CSX. This is the rail company. I sold 27.50 strike price. This was about a 2-week expiration, excuse me. Brought in 2.18%. Selling 1 contract. And kind of like Levi, the market's momentum has given this stock a nice lift. This is not a position I normally categorize as a growth stock, but that's a pretty aggressive move to the upside in response to the overall market momentum that's happening right now. So the stock at around 31, a little bit above that. I'm in a nice position here to let this wrap up and expire worthless. Let's take a look at the options chain. This does have weekly options, as we can see. And there we go. Again, bringing in on this one 60 cents. Showing the asking price here right now at 20 cents. A lot of open interest, though. Again, I could probably put in a buy to close on this. At about a nickel, 2 cents, whatever. And if I'm willing to wait for that, then that would get filled. And again, same kind of stories with Levi. May have to wait for the market to come to me on that, but that would still close it early. And then I could think about whether or not maybe on Monday I wanted to roll up to another expiration. Let's go to 14 days. Here's a little under 1.5% at 31. And just shy of 2% for 3 weeks. That's not terrible. So there's definitely some things to think about here. This could be a problem. No open interest, no volume on this. So that's not great. Maybe that changes next week. We'll see. There's June week 1. May week 5. What does this one look like in terms of activity? A little bit of open interest, not a ton. All things being equal, I'm going to let this expire. We'll see what happens, and I'll look for an opportunity to redeploy again. So, all right, Barry, thank you. Yeah, I saw this headline this morning. He was assigned Foot Locker back in December at $22.50, brought in $1. It crashed soon afterwards and stopped paying dividends. Soared over $10 to yesterday, so I sold it outright for $23.50. Good job. That's pretty awesome. And the catalyst for the move, and let's just go ahead and take a look here at this one. Pushing up to 23.79 now. You're right. It did crash after that. This latest move is spurred by news that they have made a deal with Dick's Sporting Goods. So Dick's Sporting Goods is going to buy Foot Locker, and the price is around. Let me try to see here. $24 in cash. Now, for someone like me, for full disclosure, I'm in on Foot Locker at a much higher price. So it means taking if I'm going to hold this through, taking the shares of Foot Locker, letting those convert to Dick's, and see what happens from there. Dick's is at a much higher price, $189, but they've been much higher. So maybe there's an opportunity here. If you've been holding this one long term like me, you let those shares convert. It's a dividend paying stock, and then you wait for an opportunity to see the price rally to a level that gives you a better exit. So that might work out. We'll see. That may be more hope than anything, but that's the catalyst for Foot Locker. In the meantime, Barry, you got a winning trade on that, and closing that out at a gain. You made $100, and just on the capital gain, plus the $1 in premium from when you sold the put option in December. It's not a huge win, or excuse me, not a huge gain for the time period if you think about it on an annualized basis. But this is one I would just chalk it up as a win and move on. Okay. Thank you, Barry. Okay. LRCX is coming up next week. Let's just go ahead and touch base on that one. This is another stock this is in the tech sector, and so this is one that has been benefiting from that positive news with the stock up here around 83.70. So there's a week to expiration here, and so with the stock sold the $73 strike price, brought in 2% on this one. So keep the $1.50 premium in mind on this one. And with a week to expiration on this, there's an opportunity to see in a little more practical sense what kind of opportunity there may be to leverage this. Okay. So here's the $73 strike that I sold. Expires next week. I am not going to pay attention to the $1.28 ask. I just don't. No, that's not going to be real. And the stock's momentum has moved this to the point where the last trade was about 2 days ago. But maybe go in, could maybe put in a sell to close on this if I wanted to close this out now. Where I didn't want to take any chances and didn't even wait for a call sell. That's perfectly okay too. An opportunity to clear the board a little bit is not a terrible thing, especially if it gives you a little bit more financial flexibility and a little bit of a gain on the trade. So I count that as a win no matter how you did it. I could put in a buy to close, say at 60 cents, take maybe about divide that by 2, and maybe put in a bid to close at 60 cents. I'd hang on to 90 cents if that trade took, and could then consider whether or not to roll up. 83 is the first out of the money strike price. There's $1.24 for 7 days at that level. For 7, let's see, or $1.87 for 2 weeks. Interesting. A little over 2% for 14 days on that one. Or if you think that maybe the stock is starting to lift up a little too much, and maybe you think maybe it could reverse, have a little bit more downside here. We are starting to see some distance between the stock's current price and where its moving averages are. The larger that gap becomes, the more that means that bullish momentum accelerates, but you also expect at some point for some profit taking to start putting some pressure on the price. It certainly doesn't guarantee that it's going to move lower, but but it could start to sell back a little bit. In fact, that's what's happening right now a little bit, is we're seeing the stock coming back off of a peak. What is this? Probably around 85. Let's see, 85.50. The lack of activity in the contract that I've sold is also enough that I may just have to. The other alternative is you may just be forced to let this play out for the week, and that happens too. So not all the time, but sometimes. Okay. The last one that I have on deck that is scheduled for expiration this week is a covered call on Skyworks. Now, I was assigned this one at late March at 67.50, and the momentum in the early part of the month in the stock gave me an opportunity to sell a $70 strike price covered call, bringing in about 2%, $1.40 on this. And the stock's at 72.85 now. Now, this is interesting. Here's the $70 strike that I sold. I bought the stock at 67.50 from that assignment. So I've got a capital gain built in here of $2.50. I also brought in $1.40 of premiums. So my net gain here is $3.90, and my numbers are running together. I apologize. But with the stock at 72.78, if I didn't use the covered call here, I'd be looking at a gain of a little over $5 per share. So did I make a mistake on this one? My net gain on this is going to be $1.10 less than it could have been if I just simply tried to ride the stock's momentum. So what are your thoughts? The fact is, when I sold the covered call, implied volatility was enough to make the $70 strike price attractive and useful, but the stock was about a little over a dollar per share below that point. And so this came afterwards. That was unexpected. Pushing a little bit closer here. I'm going to call this a trade war gap, or absence of a trade war. This is what happens sometimes when you're selling, when you are the option seller, and when you are using covered calls on stocks that you own. This is why I say a lot that you have to be willing to acknowledge when you sell a covered call that you are putting in a literal cap. Excuse me. You're putting a literal maximum, literal cap on the total capital gain that you're going to see in the stock. And my cap was at $70. Whether the stock is at 73, 76, 80, 100, doesn't matter. Once you sell that covered call, that's where your cap is. So you have to be willing to accept that and understand that means that sometimes you're going to be giving up additional gains. There are enough covered call trades that I place where even if I get called out, I get called out pretty close to the strike price that I sold. And so I don't really miss a whole lot of opportunity in a lot of those covered call cases. And in most of them anyway, once I'm out of the stock, I usually go and I find another opportunity in a different stock. I may recycle and reuse the same stock again, but in a lot of cases I just move on. So I really, to be honest, I don't worry too much about the missed opportunity here. And Gib, you're exactly right. Depends on what your entry goal is. I'm really just trying to look for opportunities. Number one, I want to generate some attractive income upfront from the put sale, and set up an opportunity to buy a stock at a price that I think is reasonable. Then, if I do get a positive move in the stock, I'm going to actively look for an opportunity to sell the covered call because I don't know how long that momentum is going to last. I don't have the ability to see that far in the future. So I'll look for an opportunity to set up a good covered call trade again, bring in some immediate income. If I can bake in a little bit of capital gain, then that's kind of extra extra frosting on my cake, and that's great. But I also don't try to get greedy here because if I get called out, that gives me my money back, and I can redeploy and restart again. Same stock, other stock, whatever. There's lots of opportunities. So it's really just trying to keep that income generation machine going, and think about what kind of context is good enough. I'm not trying to hit a home run. The 2 baggers, 3 baggers, 4 baggers that we sometimes see, and Barry's had a couple recently, which are pretty cool. Not really looking for those. I like getting a lot of singles, if we want to use baseball analogies. I like being able to get on base a lot. So Barry has a 5-day trade on Walmart. I'm in it at around 60. Sold a 100 call for $1.10 that expires today. Only 1.1% on the call, but annualized, again, you're right, especially if that was only a 5-day trade, Barry. Yeah, and you're already in it, and you've already got a nice gain. You've been able to ride this. This isn't a 2-bagger yet, but you're in at 60. So you're in somewhere around this neighborhood, and you've been able to ride it all the way up here to where it is a little bit above 98 so far. That's nice. With a covered call that is going to expire in all likelihood, and give you another opportunity. And just to be clear, let's just go ahead and run the numbers. Price keeps climbing, true. Is it going to be able to climb far enough to move above? Remember, it's got to move above 100 to get you called out, right? And this previous peak is more like 99, 99.50. I'd be surprised if it breaks 100 today. Now watch, just because I said that. That's going to be what happens. If it does, you'll get called out, but you'll still have a $40 gain, right? But let's do some quick math on Barry's covered call, because this is nice. Brought $1.10. And actually, if you think about it, if we go back to you really want to do this based on your purchase price, not on the strike price that you sold. That's 1.83%. News came out they're raising their prices. So whether or not that hurts or helps depends on the consumer. Is Walmart raising their prices going to blunt consumers' ability to keep buying? If sales volume starts to taper, that's probably not great. But if the consumer remains resilient, then it probably doesn't matter, and we'll see the stock continue to move higher. But in any event, 1.83%. That's for 5 days. So not 1.1%, Barry. You want to base the yield on the price you bought the stock at. So we think about that. 365 days. If you're able to do that every 5 days, that's 73 trades. Oops. Times 73. What Barry likes, everybody, is this. He got one tick earlier, then he wants a big one right here. This is the Walmart win. There you go. That's nice. Barry, I like it when you share these, because these are good examples of different ways that you can apply what we're talking about in different ways. You can apply the concept to really, really nice effect. Want to talk about low-hanging fruit in the market? This is exactly what that is. Very few people would actually go and look at, very few people would see that move in Walmart, go and pull up the options and say, oh, you know what? For 1 week, I could go and sell the $99 call and bring in $1.09. I could bring in a little over one. Most people would pass on this. But this is exactly why I talk about the low-hanging fruit. That's exactly what this is. It's just there. It's just waiting for people to pick it up. So 61.67 put sale for 90 cents back in March of last year. You've been collecting modest dividends and riding the stock higher. Yeah, for a little over a year. So that's been nice. And you did about 1.5% on the put sale. So that's a win. That's a good trade, Barry. There's no other way to describe that except as a really, really good trade, as a nice result. So I like it. Okay. This week I had a put sale on Pfizer that I was able to place at $22.50. Now this is an opportunity for me to try to lower my cost basis if I am assigned. Looks like the stock is right around, it's a little bit above that point right now. Barry, you'd like to write it out, see if it can get back up to $150 and split again. I mean, that's part of the point of working with these kinds of stocks, right? Is to give us an opportunity to work with, when I use the term legacy stocks, This is not just about trying to place a lot of short-term trades, but to give yourself an opportunity to think about how you want to manage a portfolio. Are these legacy stocks that you like and are willing to hold on to for the long term? Walmart's a really great example, and I'm not just talking about because he got in at 60. But if Walmart is an example of the kind of stock that you would want to have in your portfolio long term, the numbers kind of speak for themselves. And using the put sale as the entry point just gave him an opportunity to make sure that he was buying the stock at a price that he was comfortable with. And then the dividends are attractive enough. So it kind of makes its own case, in my opinion. So it's a great trade. I love it. Pfizer is an opportunity here. Stock's just a little bit above it right now, so we'll see if it can maintain the momentum that it's got. I sold the 2250, which is just a little bit below that right now. And this trade's going out about 2 weeks. So we'll see if it can push above the 20-day moving average, starting to slope up, and we've got a little bit of an upward trend starting to form. If that can hold, then this will be a nice trade. If I get assigned, that's okay too. I also was assigned shares in this much little over a year ago at a much higher price. So this is an opportunity for me to try to average my cost a little bit lower. Reason for the odd strike price right after the split. Yep. And so we'll see on Walmart, Barry. You're exactly right. Will it do the same thing again? Who knows? It could get up to 150 and they don't split. So we'll see. Either way, you've got a great result going for you. Going back to Walmart here. It's tapered back just a little bit in the few minutes we've been talking about it. Not a ton on the dividend yield on an annual basis, but doesn't necessarily have to be. 23 cents per each time. They've certainly got room to increase the dividend if they wanted to. They've got a really conservative payout ratio. All right. Everybody, thank you. We are at time, so I'm going to go ahead and call it here, but I do appreciate your participation, your comments on the things we've been talking about today. We've already been in PFE for a while at 28, one-day put sell at 34 cents back in March. Okay. Starting to show some starting to show some positive momentum. It's been falling back off of about 24.50 lately. Okay, March 2024. You've been sitting in it and just taking in the dividends like I have, which are not terrible. It's a higher than average payout ratio on this one. But Pfizer has some interesting, they've done some interesting things to shift their business away from dependency on COVID vaccines and getting back to some of their core specialties. So, all right, everybody. Thank you again. Appreciate your time. If you have any questions between now and next week, don't hesitate to let me know. Reach out through email, rebelincomesystem@gmail.com. You can reach me on Discord, as I mentioned, or on Substack, whatever your preference is. Hope you have a wonderful weekend, and we'll talk again next time. Thanks.